Hello and welcome to Livewire Markets and to The Pitch. I'm Huntsley, and in this series we're talking about alternative investment strategies. Last time we talked about how alternative investment strategies are useful or can be useful in a low volatility or a benign environment, but this time we're going to examine the value of an alternative investment strategy in a volatile, a very correction-prone environment like the one we just went through in early August. And to help us through that is David Elms, Head of Diversified Alternatives at Janus Henderson. Welcome, David.
Thanks, Hans.
When I think of stocks, obviously we'll talk about alternative investment strategies, but normally if we talk about stocks, we like to say that the price of admission for superior long-term returns is volatility. But that's generally the case in stocks. Is the same said for multi-strategy investing?
The aim of multi-strategy investing is to diversify risks across multiple strategies. And in our case, we do that across our risk-taking strategies. So we have 6 strategies that take bottom-up risks in pockets of inefficiency across markets. But we try and also have the best of both worlds and make volatility go away. Now, that's never possible. As they say, the only perfect hedge is in a Japanese garden, but we do our best to find ways of mitigating risk in the portfolio. We run a 7th top-down strategy called protection.
Yeah, no, absolutely. So if I think about what's happened recently, August 5th, 2024 will probably go down in the market annals, not just for the huge volatility spike that occurred, but seemingly how full faith has been restored so quickly afterwards. How do you as an investor tend to approach volatility spikes like the one we saw in early August?
Well, it's an interesting question. I don't think there's ever been a volatility spike like the one we saw in early August. Now, we're talking now before the end of August, so possibly something will emerge that validates why we had that spike. But the really unusual thing about what happened in August compared with the other 2 big spikes, so think financial crisis of 2008 and COVID in March 2020, this one went up and came down much faster than the others. So it was a bit of a head fake in the market. We had the sell-off in Japanese markets on that Monday, August the 5th. It happened at a quiet time where there's not much trading desk coverage for things like the VIX. It also happened at a time that many senior traders were off in the Hamptons, as you do in the Northern Hemisphere summer. So the market responded dramatically on news that was very Japan specific. The market went up a lot. This is the VIX. It hit crisis levels, and then people said, what is it we're panicking about again? And it fell equally fast. And it's that fast fall that was unusual. It meant as somebody hedging, you had to monetize your hedges, take profits on them quickly, or you faced regret risk later in the month.
You talk about how unusual the massive volatility spike was in August, and I think COVID, I think it's safe to say, came pretty quickly by financial market standards as well. Of course, timing the market is more important than timing the market in most cases, but how much proactive preparation can you realistically do in order to mitigate those losses, protect your portfolio when sudden uncertainty arises, like the one that we saw earlier this month?
You think about scenarios. So you war game scenarios, and you say, if this happens, if the market goes up significantly for no good reason, we're going to keep some of our hedges. We may be wrong. We're going to monetize others. But it's that planning so that when something happens, you're not sitting down and trying to invent the playbook. You're just saying, we've identified it as scenario 2. We're going to play scenario 2, and we're going to behave in this way. So you can never model things perfectly. You're always going to be surprised. You have to ad lib, you have to respond, you have to be nimble. But the more planning you can do, the better your chances are of delivering the right outcome for your investors.
Okay, so take me inside Janus Henderson headquarters there in London then. What kinds of trades, what kinds of strategies were you using when everybody else was panicking?
You can't create the strategies when everybody is panicking that benefit the portfolio. You need to have them in place before. There are some strategies that will attempt to use price information to pivot and effectively reshape the portfolio dynamically. Trend following is a great example of that. When prices fall a little bit, they often fall a lot. A trend strategy gets in front of that. But in an environment like we saw in early August, things are moving too fast for that. You have to have the strategies in place, and you have to respond to the moves in the market and the implications of those for your strategies.
Is there a specific example you could give me just in terms of like So, say one of the strategies that you use, how it works, and then how would that have applied in a scenario like the one we saw?
So a nice example, and it appeals to me as a derivatives trader, is VIX call options. So the VIX index, the global fear index, is an index of the pricing of options on the US stock market. And when it's high, the market is fearful. Options are expensive because options limit people's losses in a crisis. Somebody had the bright idea of having options on the VIX index, so you can bet about the VIX index going higher or lower. And then, of course, you can just perform the same calculation on the VIX options and create something known as the VVIX, which is the second order VIX. Now, anybody who read a lot of financial markets knew the VIX was cheap this year. You mentioned it earlier in your introduction. VIX was cheap, but what was somewhat less known as the VVIX was cheap. So not only was the VIX low, but options to bet on the VIX going up were very cheap. So one of the things we did was spend a small amount of money every month on buying these high payoff VIX call options. And that's something that worked for us, but we had to be really quick monetizing it, because if you didn't monetize it, they went up, they went down again, and you had to look back with regret on the profits you missed.
Beautifully explained. David Elms of Janus Henderson, thank you very much for explaining that to us. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Markets website as well as our YouTube channel. And we'll see you again soon for another episode. Thanks for watching.